I've never lost money in any stock in my entire investment journey. If I had known these 5 tips before I actually started, then I would have increased my account value at a much greater pace than I have now. I have been investing for many years now. Now the point of this video is to accelerate your investment journey and for you to make a more informed decision and hopefully make more money with every stock you invest in. Before we get into the video, my name is Jag. I make all kind of videos on stock market and investing. If you're interested in that, then please make sure to hit that subscribe button down below and hopefully you'll get a valuable return for that. Also guys, while you're there, make sure to sprinkle a little bit of that like button because it really does help out the channel and keeps it growing and allows me to make more helpful videos for you. Investment tip number 1. So you found a news article about a company. You have then researched into it and thought, hey, this company might do well in the future. So you open up your brokerage account and think, hey, I'm going to invest £1,000 into this company. Now here's what you need to know. Instead of investing a large amount of money straight away, you need to spread this out in various intervals by a monthly or a weekly basis. So for example, let's say you're investing £1,000 into Apple. You might want to spread that out at £250 a week for a month. And I'll tell you why. This concept is called cost averaging, also known as dollar cost averaging or pound cost averaging. And it's all about investing a same fixed amount of money in a particular stock regardless of any price fluctuation, rather than actually investing a large lump sum at once. This strategy allows you to ride out any peaks in the stock price and allows you to buy more stock at lower prices. Let's say you bought £1,000 worth of S&P 500 at £52 a share. Then the next month it went down to £48 a share, and the next month it went at £49 a share, and then it went back up to 51 and then back to 52. Now if you spread out your investment in these intervals, you would have decreased your average buying price and you would have been making a better return than you would have if you just put £1,000 up front into the £52 price. But some people might say, hey, what if I buy at $48? The lowest price. Well, to those people I say, be realistic. It's very unlikely that you're going to be able to time the market each time, which is why this strategy or this tip works so well. Also, this strategy takes the emotional aspects out of investing, as more people are going to be more anxious when they invest £1,000 just a lump sum up front. They might be more compelled to sell when they hear some bad news about the stock. However, if you dollar cost average for let's say 4 months, your money's been in the market for 4 months. Just by the simple fact that your money's been in the market for 4 months, you'll be less anxious about it. And hopefully you'll start investing in a more mechanical way. The second investing tip I would say is that with investing, you need to realize that less is more. I noticed that many people who work in many other industries such as retail or any other kind of business that involves selling products, they think, hey, if I'm making X amount with each trade, then that means that I need to make X trades for me to actually make X amounts of money. They start calculating how many trades they need to do, and this whole strategy is totally wrong. To find home run trades, the trades that are actually going to 10x your money, is actually hard to find. So you're going to be able to spend a lot of time doing that. You're better off making less trades and making more money with each trade than trying to force yourself to hit those numbers in terms of quantity of trades. With this mindset, you're going to be pressured into actually thinking, oh, I need to push out a trade this week. So you're going to be forced into making decisions you shouldn't make. Personally, in my entire investment journey, I have not made more than 30 investments, which shows you that I'm investing in quality, not quantity. Apart from obviously the S&P 500 index fund, which I constantly put money into. Now 30 is quite a low number, but I'm very conservative of what I invest in. And if it makes sense for me to invest at that time, then I put my money. I put a higher amount of money into each individual investment, and rather than picking out 100 investments a year and putting small amounts of money in each and every one of them. For beginners in investing, you need to remember that investing is a long-term game. Many newbies get into a habit of looking at various charts and various different instruments throughout the day and always looking out for the next thing, which isn't a bad idea, but they're more compelled to just put money into anything that the news says that is going to rise. Guys, you need to just step back and think there's many opportunities that will come in the market, and you need to be more mechanical and kind of emotionless about trading. The fact is, in the stock market, there'll be many opportunities that will come into the market. It's all about investing in smarter trades, working smarter, not harder. Guys, a quick reminder before we hop on to the next tip, please make sure to smash that like button if you're enjoying this video so far. Investing tip number 3, taking profits too early. Guys, you forget the amount of work you did to actually find that stock, all the research you did to find a good investment. Newbies tend to invest in the company, and then once they're making a few quid, they just exit out that position and take that few quid and try to hop onto the next thing. Based on my experience in this, I personally believe that stocks that are rising are going to keep rising. For example, you're most likely to get a 15% extra return on Apple than you taking your money out of Apple and then hopping on to the next random stock. Investing tip number 4. This is a very, very important thing for any newbies that are getting into stock market investing. A lot of newbies suffer from this. And guys, you need to stop treating investing emotionally. There will be times where you read the news and the news will tell you that this stock is going to go high and higher tomorrow, or this stock is going to suck, and or this stock sucks really bad and you should just dump your positions in the stock and it's just a meltdown going on. What you must remember to do is do not trade on the fear of missing out. A lot of the time in the investment journey, you might find some news which makes you more compelled to actually put money into that stock, because you're scared that you're going to be looking yourself into the mirror in the next 6 months and thinking, what the hell, what's wrong with me? I should have put money into that company. The truth is that buying off the news is not a good strategy. The chances are, if it's already on the news, you're actually buying too high anyway. A lot of other people are doing the same thing, and if you have not done the fundamental analysis of the company beforehand, which the chances are you're not going to be able to do because you're buying straight away, you might be paying a considerably higher price than the company's actual worth, which is why I tend to wait it out and actually do my full performance analysis before I actually go about buying a company. Investing tip number 5, buy stocks you understand. There are so many stocks into the stock market, so many opportunities for growth and decline. Imagine you're buying some random insurance company which operates in a specific niche. Think to yourself, before you buy a company, do you really understand the business model? Do you understand the different aspects of where the revenue is coming from? The reality is that you have a better chance at winning with each investment if you understand the company well. If you're a user of that company, you know how they're making their money. So you probably can understand the balance sheet of the stock better, and therefore you'll be able to make more informed decisions about the company rather than just investing in some random company in another corner of the world. I would go as far as saying invest in companies that you actually use products and services of. You'll be able to understand where the management of the company is actually coming from, because you are a customer. You understand if this service is good or not. And by being a customer, you're able to understand at a better rate whether the company is actually going in a good direction or not. Guys, there is definitely more investing tips out there. If you want me to do a part 2 of this where I look at this from an intermediate angle and not beginner, then drop it in the comment section below. Hopefully you are understanding the tips well and you're ready to get going. If you are ready to get going, then please make sure to check out my video here on where I discuss the top 5 index funds to invest in 2021. Or here where I talk about how I made around £5,000 from just 2 trades. With that being said, thank you so much for watching, and I'll see you in the next video.